While everyone else is running around screaming about a housing crash, smart money is quietly buying properties at a pace we haven't seen since 2021. The crash already happened, just not the one you're expecting. And if you're still waiting for prices to collapse, I'm about to show you why that may be the most expensive mistake of your life. What's up, everyone? Welcome back to another episode of Survive the Crash. Look, I get it. Oil prices just dropped below $60 a barrel. Trump's tariffs have everyone freaking out about supply chains. Tech stocks were getting hammered. And your friends keep saying, just wait 6 months. Housing is about to crash. But what if I told you they've been saying the exact same thing for 3 years now? And what if I showed you why waiting could actually cost you hundreds of thousands of dollars? Today, I'm going to break down exactly why real estate remains the ultimate hedge against economic chaos, using actual data, not fear-mongering headlines. But, because let's face it, financial talking heads have predicted 15 of the last 2 recessions. And when it comes to real estate specifically, well, their track record is even worse. But before we dive into the market data, I want to share something very personal. In May of 2008, I bought my home in San Jose, $784,000 with about $400,000 down. Yep, you heard that right. I bought at what turned out to be the absolute peak of the market, right before the biggest housing crash in American history. Within 18 months, my home's value had dropped nearly 30%. On paper, I lost about $235,000. Friends thought I was crazy. Family members, they were worried. Co-workers, they whispered. But here's the thing. Today, the same house is worth $2.2 million. That's nearly triple my purchase price. But the real value, well, that's something that can't be measured in dollars. It's the vegetable garden where my wife and I learned to grow tomatoes. It's the pool where we hosted countless summer barbecues, and if you're in San Jose, you've probably been there. The patio where we drank tea after Nowruz, our Persian New Year celebrations. The living room where friends gather to play music and tell stories. It's even the quiet corner of my balcony where I received the news that my uncle had passed away. I don't care that I bought at the peak. It was one of the best decisions I ever made. And here's my point. When I look back over those 17 years, you know what I never think about? I never think about if I could have saved 15% by timing the market perfectly. What I do think about is all of the life that happened within those walls, and how much more expensive that house would have been if I'd waited even 2 more years. Just this last couple of weeks here, we were at Seezdah Bedar, the traditional Persian picnic that ends our New Year celebration. I lost count of how many people pulled me aside to ask me, hey Ramin, is now the time to buy, or should we wait for the crash? And I'll be honest, part of me wanted to tell them to wait. It'd be the easy answer. It's what they wanted to hear, the comfortable answer. The answer that wouldn't put my reputation on the line, but my conscience wouldn't let me. Everything I've learned from my mentors like Barry Habib, the rebel capitalist George Gammon, everything the data shows, every historical pattern, all of it pointed to one conclusion. Waiting is likely to be the most expensive decision that they could make. And I refuse to tell people that was comfortable when I believe it would cost them their financial future. So let's talk about what's actually happening right now. The unvarnished truth about our economy. Oil prices are below $60 a barrel, historically a signal of economic slowdown. When energy costs drop dramatically, it indicates a decreasing demand, which suggests economic contraction. The stock market is experiencing its highest volatility index in 18 months, with massive outflows from tech and growth sectors. Just last week, major institutional investors shifted billions away from Silicon Valley darlings to guess what? Physical assets like real estate investment trusts. Trump's tariffs have triggered legitimate supply chain concerns. Construction materials are already seeing price increases in anticipation of higher import costs. One builder I work with just locked in lumber contracts at a 12% premium compared to the last quarter because they're terrified of what's coming. Inflation remains stubborn at 3.1%, still above the Fed's target rate. Core goods inflation is moderating, but services inflation continues to run hot, which suggests persistent economic pressure. And everywhere I go, people are saying the magic phrase, I'm waiting for mortgage rates to drop. It's like a mantra being repeated in coffee shops all across America. These factors would normally signal a recession, right? And recessions mean housing crashes, right? Except they don't. That's the narrative financial media sells because scary headlines drive clicks, but it's not what history actually shows us. Of the last 6 recessions before 2008, do you know how many times housing prices actually fell nationwide? Once. Just once, 1991. Prices dropped a whopping, are you sitting down? 1.9%. That's it. During the other 5 recessions, home prices actually increased by an average of 4.6%. Even the 2001 dot-com crash and subsequent recession saw home prices rise by 6.6%. The severe 1980-1982 recession with 10.8% unemployment. And you heard that right, 10.8% unemployment. Housing still appreciated 1.9%. But what about 2008? Well, that crash was real, right? Absolutely. But it was also the exception and not the rule. And today's market has fundamentally different conditions than 2008. I'll explain why in a minute. But here's what no one's telling you. What if the crash already happened? Between 2022 and 2023, when mortgage rates jumped from 3% to 7%, we saw the most dramatic affordability crash in modern history. Transaction volume dropped 40%. Buyers disappeared. The monthly payment on a median-priced home increased by over 50% in just 12 months, the largest affordability shock ever recorded. And yet prices only dipped temporarily. In most markets, they continued upward. In fact, 2023 finished with home prices hitting all-time highs in 86% of metros tracked by the National Association of Realtors. Why? I'll tell you exactly why. But it's going to challenge everything you think you know about housing economics. And it's the single biggest reason I'm more bullish on real estate than ever before, despite all the negative headlines. Now, let me show you some hard numbers about waiting for the perfect time to buy, especially in the Bay Area. If you're looking at a $1.5 million house, you might want to write this down. $1.5 million with 20% down at today's rates of, let's say, 6.5%. Your monthly payment is $7,585. If prices rose just 5%, the historical average, that same house is now $1,575,000. So $75,000 over. If rates drop to 5.5% by then, which many people are hoping your payment would be $7,153. So you save $432 by waiting. Sounds good, right? Wait a second. What if prices rose 8% instead of 5, which Bay Area markets are seeing at this point, more like 10 to 12? And what if rates only dropped to 6% instead of 5.5? Well, your house just went up in value to $1.6 million, $20,000. Your payment is $7,770. You lost money waiting. And this doesn't even account for the lost equity buildup and the tax benefits during your waiting period. Let's look at a more aggressive but entirely realistic scenario for our area. What if prices rose 10%, which happened all over the place, and rates only dropped to 6.25%? Well, your house is now worth $1,650,000, and your payment is $8,112. Now you're paying $527 more per month for waiting. Plus, you lost a year of principal paydown reductions and tax deductions. Oh, and your down payment requirement, well, it increased. It just increased from $300,000 to $330,000. I see this play out with real clients every single day. Just last week, I met with a couple who've been waiting since 2021 for the coming crash. In that time, the Sunnyvale townhome they were eyeing at $1.2 million, well, it rose to $1.45 million. Their decision to wait cost them $250,000 in appreciation alone, and they're still renting at $4,200 a month. That's over $100,000 in rent that they've paid while waiting for the perfect time. Money that built zero equity. If they had purchased instead, about $36,000 of their payments would have gone towards principal in those 3 years. That's on the top of the $250,000 of appreciation that they missed. In total, their decision to wait cost them nearly $400,000 in wealth-building opportunity. This is the real cost of waiting. Here's the fundamental issue that the crash predictors keep ignoring. We have a massive structural housing shortage in America, and it's getting worse, not better. We're currently short between 1.5 to 3.8 million homes in the U.S., depending on which study you believe. New construction still hasn't recovered from the old underbuilding for 15 years. Well, look at these numbers. In the 1970s, we built an average of 1.5 million homes every single year. In the 2010s, we built an average of just 900,000 homes every single year. That's a 40% reduction in new home supply, despite population getting bigger. And in the Bay Area specifically, well, that situation gets even more extreme. We're building at roughly one-third the rate needed to keep up with job growth. Last month, I spoke with 3 different national builders who told me the exact same thing. Rising material costs and labor shortages mean they can't profitably build entry-level homes anymore. The numbers simply don't work. One builder in the South Bay showed me their cost sheets. In 2019, they could build an 1,800 square foot home for about $700,000. Today, that same house costs over $950,000 just to build, before any profit margins. With current regulations, impact fees, and material costs, building affordable housing is nearly impossible in most Bay Area markets. Meanwhile, on the demand side, millennials aged 27 to 42 are in their prime buying years. With 72.1 million Americans in this cohort, the largest generation in American history. Gen Z, ages 11 to 26, is beginning to enter the market, with 67 million more potential buyers coming of age. And record immigration levels mean approximately 1 million new households forming annually, all competing for a severely limited supply of homes. This is not 2008. The fundamentals are completely different. In '08, we had a massive oversupply, with builders constructing 2+ million homes annually in the years leading up to the crash. We had predatory lending, with no income verification loans and adjustable rate mortgages being handed out like candy to children. We had record low homeowner equity, with many borrowers underwater from day one. Today, well, we have record low supply, the strictest lending standards in history, and the highest homeowner equity levels ever recorded. The average American homeowner has $330,000 in home equity as of Q1 in 2025, this year. And foreclosure rates, well, they're still well below pre-pandemic levels. In February of 25, just 0.26, 1/4% of all mortgages were in foreclosure, compared to 1.4% during the 2010 to 2012 period. The toxic loan products that caused '08 simply don't exist anymore. There are no more ninja loans. No income, no job, no assets. There are no more negative amortization loans coming out. No more 228 arms that reset to unaffordable payments. Borrowers have been heavily vetted. Debt-to-income ratios are strictly enforced. The regulatory framework created after '08 has fundamentally changed mortgage lending. So what should you actually be doing right now? Well, here's 5 strategies my most successful clients are implementing. Number 1, buy now, refi later. Lock in today's prices with today's rates. And if rates drop, which they will, you can refinance. But if rates drop and everyone jumps back in, well, prices are going to surge even higher. Remember, you marry the price, but you only date the rate. Number 2, look at alternative financing. Seller financing, adjustable rate mortgages with plans to refinance, or even private lending can bridge the gap until traditional rates improve. I just worked with a buyer who negotiated a 2-1 buy down, where the seller paid to reduce the interest rate by 2% in year 1 and 1% in year 2. This gave them time to settle in while planning for a refinance in year 3. Number 3, consider new construction with rate locks. Many national builders are offering 6 to 12-month rate locks of below market rates through their preferred lenders. Then come talk to me. I have clients who locked in 5.875% for 9 months while their home is being built, nearly a full point below market rates. This is one of the few genuine bargains in today's markets. Number 4, house hack your way into ownership. If a single-family homes are out of reach, consider a duplex or a home with an accessory dwelling unit. I just helped a client purchase a duplex last month. Yes, she paid 7% interest, but the rental income from the second unit still covers all expenses plus $600 in profit every single month. And in 2 to 3 years, when rates drops, she'll refinance and increase that cash flow even more. Number 5, focus on cash flow, not appreciation. If you are an investor, the deals are actually better now because competition has thinned out. Properties might cost more, but fewer people can qualify, meaning less bidding wars. One investor I work with just acquired a 6-unit building in East Bay that cash flows $2,800 a month after all expenses, something that would not have been possible to find in 21 to 22 when prices were lower, but competition was fierce. The key is to stop thinking like consumers and start thinking like investors. The wealthiest real estate investors I know don't obsess over getting the absolute lowest price or the absolute best rate. They focus on the spread of their cost and capital and their return on investment. And right now, that spread is still highly favorable in most markets. What if instead of trying to time the market perfectly, you focused on time in the market? Almost every real estate millionaire I know made their fortune by buying when others wouldn't, holding long term and letting inflation and rent increases work their magic. Let me tell you about my client George. He bought his first fourplex in 2010, right after the housing crash. Everyone told him he was crazy. Prices will keep falling. The recession isn't over. Wait until next year. George ignored them and bought anyway. He paid $480,000 for that fourplex. It's worth over $1.3 million and generates $7,200 in monthly rental income. His mortgage payment, still $2,800 per month. That's a $4,400 monthly profit made from a single decision made during uncertain times. And here's the kicker. If George had just waited one more year to pull the trigger, that same fourplex would have cost him $540,000 if he could have found it at all. His indecision would have cost him $820,000 in appreciation and about $100,000 in lost rental income. George didn't have a crystal ball. He wasn't some real estate genius. He just understood one fundamental truth. In the long run, real estate almost always goes up, and the cost of waiting is usually far greater than the cost of imperfect timing. Now let me leave you with this. In 2010, after the worst housing crash in American history, the median home price in the US was $175,000. Today, it's over $400,000. And even through the worst crash we've ever seen, long-term holders still more than doubled their money. And that's just price appreciation, not including rental income, tax benefits, or mortgage repayments. Market timing is a fool's game. The data doesn't support it. History doesn't validate it. And the wealthiest real estate investors I know don't practice it. Every single generation has had their reasons why now is a bad time to buy. Inflation in the 70s, double-digit interest rates in the 80s, recession in the 90s, dot-com crash in 2000, the housing crisis in 2008. Yet through all of that, real estate has created more millionaires than any other asset class. So while everyone else is paralyzed by fear and contradictory headlines, ask yourself this. In 10 years, will you be glad you waited? Or will you wish you had bought when others wouldn't? History suggests the answer is clear. Will you be the person who bought in 2025? Or the one who waited and watched others build wealth? I've been in this business long enough to know that in a decade, the people who bought today, they'll be celebrating. Just like I'm celebrating my terrible decision to buy at the peak in 2008. Because the truth is, there's never a perfect time to buy real estate. There's only your time. And the longer you wait for perfect conditions, well, the more wealth building time you lose forever. Well, if you made it this far, you're already smarter than 90% of the buyers out there. Hit subscribe if you want data, not drama, and click that notification bell so you don't miss next week's video on the top 3 Bay Area markets to buy in 2025. Drop a comment with your biggest question about today's market, and I'll personally respond to as many as I can. Until next time, remember, the best time to buy real estate was 20 years ago. The second best time, well, that's now.